Hello, everybody. Thank you for joining us for our COVID-19 update today. Our topic today is PPP, tax credits, payroll deferral, and more. My name is Lee Schwartz. First of all, on behalf of SVA, we hope you are all healthy and adjusting to whatever it is you call this. We've been doing our best to be a resource for the business community, and today's webinar is another way in which we're trying to communicate out the latest and greatest information available. Today's presentation will cover everything we know at this point in time. Please keep in mind this information is fluid and is changing quickly. I also want to make it very clear. If you have questions coming out of this webinar and you're an SVA client, please reach out to your SVA professional. We want to help. If you're not an SVA client, your best bet may be to go to your existing CPA. They know you and your business best. But if that doesn't work, feel free to reach out to me directly. We know this is an incredibly difficult time for all of you, not just as business owners and managers, but just on the personal side too. If there's anything we can help with, we're happy to do it. So, we all need to help each other during this time. But I'll get off my soapbox. Our presenters are going to begin with some discussion around cash flow support and planning. Then they'll dive into other tax credit options, and they'll finish with an overview of where all the PPP money went and a panel discussion. Many of you sent in questions ahead of time. We've done our best to integrate those into the presentation, but we are going to try and leave some time for Q&A at the end. To ask a question, you're just going to need to open up the chat function within Zoom and address your question to all panelists. Try not to submit questions until after we've finished with the topic. We're going to try not to duplicate information. Also, we are recording this webinar today. You will receive an email with the link to a survey, as well as our SVA resource page where the webinar recording will be available. With all that out of the way, our presenters today are Eric Trost, Dan Glomsky, and Nancy Melberg, all principals from SVA. Having said that, I'd like to kick it off to Dan.
Thank you, Lee. So we want to start today with just a little bit of things to consider and ways to potentially generate some cash flow in your business. So my primary objective is to, one, introduce some cash flow opportunities that the government has put forward. Hopefully that helps you maybe either build or reserve some cash flow, or it's cash that's needed immediately now. So that's one objective. And then the final one is, keep in mind that a lot of these tax changes are really somewhat designed to help keep good employees on payroll. So let's kind of try to remember the agenda of the tax law changes that have been put forward. I'm also going to put a little disclaimer out there that the information that I cover is on a general context. Each situation seems to have a unique twist to it. So again, take this information, start the thought process, and consult with an advisor as far as the application of particular things. So with that, I'd like to start first with the FFCRA, which is the Family First Coronavirus Recovery Act. This bill was the first tax bill that was introduced, and the effective date of it is April 1st to December 31st. So what that I'm really basically saying is, to apply for these particular credits, you really have until the end of the year to apply for them, but we need to make sure that we're meeting the particular criteria. So the FFCRA credit is available to all businesses and even has some application for self-employed individuals. The reality of it is this credit opportunity really is for those individuals that are not able to go to work. So if I'm a self-employed individual, chances are I'm probably still trying to do some work or doing some work, regardless of the fact of my other needs with my family or my own individual situation. The FFCRA credit really has two components to it. The first component is the sick leave wage. And this is we say 80 hours, but it's a two weeks of pay that an employer can pay to an employee. The max range is $511 for there's 6 criteria that we want to meet. The first 3 of those criteria are eligible for the max of the $511. The second 3 criteria have a max of $200 a day of compensation or credit available. In addition to those $511 and $200 amounts, you get to also apply for a credit for the health insurance, any HRA contribution, and the employer's Medicare tax. So the credit is actually higher than $511 per day per employee, assuming you have those other components. Now let's get into the criteria a little bit. So in order for somebody to apply for the sick leave wage credit, you first have to meet one of the 6 criteria. The first one is that there is a government or federal, state, or local quarantine or isolation requirement. There was some discussion out there whether that would actually qualify, based on a stay-at-home order. There was a regulation issued by the government that stated that it's a broad interpretation and that stay-at-home orders do qualify. So that is one that allows us for the $511 zone. Additionally, if you were advised by a healthcare professional to stay home, that's also eligible for the $511 max. And then you have symptoms, and then you're in the process of getting some medical diagnosis. So if that happens within, from April 1st to the end of the year, you can look to compensate an employee up and get a credit for $511. The next 3 criteria is, have a need to care for an individual that is quarantined, that you have a need to care for a child as a result of the school closures. And then the 6th is the ability to have similar circumstances that might also put you in that same zone. Those types of meeting those obligations puts a $200 a day max on that. So we have 80 hours of work that can be, credited for those types of things. Then we have a subsequent 10-week process that you can also apply a credit for if you continue to pay an individual and they are still required to stay home to take care of a family member, a child, or similar circumstances. The critical piece on this, though, is substantiation. So you need to make sure that you document the name, the date the individual became sick or unable to work. And then third is to get a statement from the employee that they met one of these criteria and what specific criteria they met. There's an ability to claim this credit 2 ways. One is a form called 7200, which is a special COVID form. It's actually a 1-page form, so it's not a long drawn-out process, but it's more intended for a way to get access to the refund as quick as possible. The other alternative is inserted onto your Form 941. So the other thing that we want to talk about on this, and we'll get into it on other credits, is that the credit for an FFCRA is considered to be income for the business when they claim that credit, but they are also able to take the deduction. So in theory, it's a revenue neutral position for the IRS. We'll see in a couple other ones where the income is not taxable, the credit's not taxable, but then you have to reduce the expense by the amount of credit. So I think we get into the same answer with a different reference point. So that's really the gist of the FFCRA. And now I want to talk about the credit under the CARES Act. So the CARES Act was the one that was introduced or signed into law on March 27th. And recognizing we had this prior FFCRA credit available, the government decided that, well, we need to put a different criteria in because it's still not covering all the types of scenarios that we believe it should. So the first thing they did is introduced a employer retention credit. And this credit is not limited to, I should mention the FFCRA was limited to any employer that had less than 500 employees. In this particular case, the employee retention credit is not limited to 500 employees, but has a limitation that if I have 100 or greater employees, that I can only claim the credit on individuals that are not currently working. So if I have, 150 employees and I have 3 of them that are out, not able to work, either I laid them off or that type of thing, then I have the ability to continue to pay them and get a credit for them. If I am under 100,000 employees, then all my employees qualify for this particular credit. So what is the credit? The credit in this case is a maximum of $5,000 per employee. And it has 2 criteria that, maybe 3, but 2 of the primary our starting points is you have to be fully or partially shut down in order to qualify for the credit in the quarter you're qualifying for the credit, or your gross revenue has to be down 50% from the prior year. So you want to kind of keep in mind that those things exist. And the also thing that's really important in this process is you don't want to be applying for the PPP loan and claiming this credit at the same time. And this is important because we're going to later on talk about the March 14th date of when you have to potentially decide to return your PPP loan. And if you were to do it before the May 14th date, this puts you back in the eligibility role for applying for this retention credit. In this particular case, the retention credit is not considered to be income, but then again, you have to reduce your expenses to your for the amount of credit that you claimed. The next thing that was in this CARES Act was a payroll deferral option. And this payroll deferral option is eligible for employers that want to take and defer their payroll, even if they have applied for the PPP loan. But the payroll deferral calculation can only be done up until the date the loan is forgiven. So we have, so what is really deferrable? The deferrable amount is the employer's portion of the Social Security taxes. So it's only, it's 6.2% of somebody's compensation, and it goes from March 27th to December 31st. Just running through some math and working with some other clients, I approximate this to be, if you are trying to say, how much can I really defer? I say about $850 per employee, assuming you have an average of $30,000 of compensation being paid to an individual. So the ones that might be paying more in compensation might have a higher number. Ones that are paying less might have a lower number. But if you have a substantial amount of employees, this is an opportunity for you to defer revenue or defer some taxes. So what am I deferring? So I'm deferring the self-employment taxes of the employer, and I get to defer that in essence for 2 years or thereabouts. So whatever I defer from March 27th to December 31st, let's say that number ends up being $100,000, I owe 50% of that to the government December 31st of 2021. So on December 31st of 2021, I'm going to give them $50,000 to the government. Then the next $50,000 has to get paid December 31st of 2022. So it's an ability for you to, maybe hang on to some cash flow, get through some uncertainty. It's not forgiven or anything like that. So you don't want to be worrying or thinking that, I got this huge benefit. Really, the benefit is the fact that you're able to maybe hang on to some cash flow and work through some other issues and let the business get back on its feet as best as it can. So these payroll, both the FFCRA and the payroll retention and the payroll deferral, what I guess I would kind of recommend in this process is really consult with your payroll service provider and make sure you understand and make sure they understand what else is going on with respect to your organization. I think a lot of the stuff as far as the documentation, although the payroll service provider might take care of things for you, you have to remember that you're responsible for the substantiation and documentation of all these credit opportunities. But I think there would be an excellent resource. Certainly if you have questions further on that, we can drill into that another time. So next I want to move on to some non-payroll tax options. And the purpose of these is to kind of introduce some opportunities for us to either go and claim a credit for some deductions and get a refund, carry back, potentially get a refund, or take and push some activities into 2019 that might, if we had an obligation due for 2019, maybe we can reduce that obligation. So what I want to talk about is section 165I, disaster loss. And this is something that we've used in situations where we have had a natural disaster, a hurricane, or a flood that the government declared a national disaster. Under those situations, we would take and determine the loss that somebody incurred as a result of that hurricane. That loss then can be accelerated and reported on your current tax return instead of waiting a full year to try to report that particular loss. So we're looking at applying this to the particular situation of the COVID-19 as a result of the president declaring a national emergency as a result of the pandemic. So in order for us to qualify for this and start thinking about it, we have to really meet 4 criteria. And one is, that we can't be compensated for our losses. So if the insurance company is going to recoup our losses and we're not out any money on any of some of the examples I'm going to show you, then we can't take the loss. We can't accelerate it. The loss must be caused by an event, and we can see about the facts and circumstances of that. The event has to be closed or a closed completed transaction, which means it can't be like, oh, I lost this, but the contract's still open. That type of thing. It's got to be, it's done, it's lost. If it's inventory, I scrapped it, it's out of my warehouse and everything else. Losses have to be related to natural disaster, which means that, it's got to be COVID related. And one thing we cannot accelerate and move forward is lost revenues or declare a fair market, decline in fair market value of property. We actually have to walk through the transaction. So let me give you some examples of things that I think you should be thinking about and seeing if we can potentially move these if we had lost inventory. And I think this more in the food industry where we purchase all this inventory of food, which has an expiration date. And as a result of it, we were forced to shut down our facility. We couldn't produce, the inventory might go bad. For a restaurant, we ordered inventory. The inventory either A, couldn't be pulled back by the vendor, or B, it's just pure, spoil loss and stuff like that. So in those cases, those are losses that we incurred. We should look at, hey, are they substantial enough that we want to report them on a 2019 return? So that's one example. Closure of a store or facility, we're looking at, as a result of the COVID, you were forced to shut the location down. You're not going to start it back up. So we have closure costs with respect to that. Abandonment of leasehold improvements. Again, we leave a facility, we had leasehold improvements there. We're able to write those things off right away and take the deduction in 2019. If we have prepaid expenses that we didn't get refunded or credit, again, these are things that might not happen, but if they do, we want to be aware of them. If we prepaid for raw materials and we're not getting the money back, could be that we prepaid for something, somebody went out of business as a result of COVID. Maybe that's a potential opportunity for us. Worthless securities, but remember, it's not bad debts. This would be a company that maybe you were invested in for a business purpose and their stock went worthless. So with all these are just examples that I want to give people to start to think about and advance forward the discussion. Again, looking for opportunities to either reduce that 2019 liability or potentially file a refund claim and start infusing some cash flow back into your organization as a result of these losses. So just kind of think forward the discussion on that point. Next, we want to go into, I think it's Qualified improvement properties. So what this is another opportunity for the government advance forward to us that allows us to accelerate some capital expenditures that we made for interior portions of a building of a non-residential property, commercial buildings, right? So we're able to classify those properties now as 15-year property and they become bonus eligible. We're able to go back all the way to 2018 and 2019 if it's already been filed, and then it moves forward. But if we had some qualified improvements in 2018, we could go back and now potentially write that all off in that year. Again, maybe reducing that 2018 liability, getting some refunds, again, generating some cash flow that we can now sit on instead of waiting, you know, whatever, 39 years or 15 years to take that particular deduction. And we want to make sure that you also consult your, work with your advisor on these things, because there are options, there are strategies, and there's things you want to consider. Just because we sometimes have the opportunity to do this, we got to calculate through really what that impact's going to mean and where do we get the most value by doing that. And again, each person's situation is a little bit unique. And then the final thing I want to talk about is net operating losses. So just so we're clear, net operating losses are losses that you incur in a particular year that exceeded the amount of income that you had. And as a result of that, the loss, you know, if I had a $100,000 loss and I wasn't able to use it, historically the loss would carry forward until I was able to, you know, apply it against future income and that type of thing. As a result of the CARES Act, they went back and amended and allowed us to carry losses that existed in 2018 or 2019 and carry those back to 5 years. And again, might be an opportunity where we were in higher tax rates. Again, it makes it a good benefit to go back and carry back those losses against those higher tax rate incomes. And then there's an option to forego the carryback and decide to carry it forward. So if you have an NOL, again, it's critical that you contact your tax advisor for two reasons. One is we think it can potentially generate some cash flow for you, but two, there are things that need to be done so that you don't lose that NOL. So what, in theory, the NOL automatically should be carried back. And if you're not going to carry back, you have to you have to need to forego that carryback, which again can be done on the 2020 return, but it requires the action to be taken, and you want to make sure that that is done. So in summary, what I guess I'm just trying to make sure everybody understands is, you know, there's vehicles out there to generate the cash flow. Obviously, we understand the PPP loan is an attractive thing, but we're seeing some restrictions that might be applying to those loans that maybe make them not usable by some people. These are some alternative ways to get some, you know, government assistance on the current situation. So that's what I have for now.
Thanks, Dan. That was great information. So before we get into some of the controversy right now around the PPP loan and some of the things people are hearing out there on the news, I know that I'm seeing articles come out daily. I'm seeing everybody giving webinars on it. We hear about it on the news. So we're going to address some of those concerns that people have with some of the information they're hearing. But before we do that, I want to look at some of the statistics, and I want to talk about just briefly some of the good things that has happened in this PPP loan in the last 5 weeks. And boy, when I think about where we were the first time we gave this webinar, probably 5-6 weeks ago on the PPP, to how much has happened in these last 5 or 6 weeks, there's been a lot going on. So there's been a lot of busy people. So here's some statistics for round one, and I just want to put this in perspective for everybody. So round one, as everyone knows, was about $350 billion. Of that $350 billion of funds that went out, Wisconsin actually did pretty good for little old Wisconsin. We got 8.3 billion of it. And I want to put that in perspective compared to New York, who got 20 billion. And I think everybody knows that New York was hit really, really hard with this. You know, we've definitely seen a lot of that on the news. And California, which was the largest amount of loans that was lent out, got $33.4 billion. So 74% of the loans were actually under $150,000. So again, I know we're hearing about all these big companies, public companies that got this money, but when you look at the whole $350 billion that was lent out in the first round, 74% were under $150,000. 80% of those loans were actually funded by community banks. So I think a lot of people had some frustrations with some of the bigger banks. And I think we're seeing that in these numbers that the community banks were getting those loans through a little bit quicker, I think, than some of the bigger banks. But there was no one lender that gave more than 5% of the total loans. And then I think you can see, I just tried to list some of the industries where some of that money went. So construction and professional services definitely being the highest. And then we've got manufacturing, healthcare, and then a whole bunch of smaller percentages underneath that. So I think what I want to just point out in here is that although it seemed for the people who were involved in this that this was really rough and people were frustrated with the process, there was a lot that happened, and they actually lent out, the SBA lent out more money in 14 days than they have lent out in the past 14 years. So I think when you think about that, it's pretty amazing. And there were a lot of people working really hard behind the scenes. But I think what happens when we get a program like this that is pulled together so quickly is there's a lot of things that aren't clarified in the initial PPP. And so I think that's what we're dealing with now, is we're dealing with all the aftermath of the original lending and clarification coming through. So that's a little bit of the things that we want to talk about today. And I think, Lee, you had some questions maybe that you want to start giving us, and we can start answering those.
Yeah, sure. Thank you, Dan and Nancy, for that. We're going to take a couple minutes and do a quick panel discussion. Nancy, as you introed your piece, you talked about some questions around the return of the PPP funds. And yes, clearly that is a hot topic of conversation right now. So can you all elaborate on the SBA's question and answers surrounding question number 31 regarding returning those funds?
Yeah, so that seems to be the concern for everyone right now. So the SBA came out with some, what they do is they come out with questions and answers, and they provide them on their website, and then they publish them, and they're constantly updating them. And I'm going to read to you what question 31 was that came out, I guess, about a week and a half ago. The question was, do businesses owned by large companies with adequate sources of liquidity to support the business's ongoing operations qualify for a PPP? Well, there's a whole lot of things in there that everybody's probably saying, what does that mean? What do they define as adequate sources of liquidity? And the SBA's answer to that was, all borrowers must assess their economic need for a PPP under the standards established by the CARES Act at the time of the loan application. That becomes important because I'm going to circle back around to that a little bit later. So specifically, there was a certification on the application that said current economic uncertainty makes this loan request necessary to support ongoing operations. Borrowers must make this certification in good faith, taking into account their current business activity and the ability to access other sources of liquidity sufficient to support ongoing operations in a manner that is not significantly detrimental to the business. What does all that mean? That's what we're all trying to figure out here, I think. But basically, I think what they're getting at is they're really looking at the need that companies had for this particular loan. And I think what you have to do is you have to look at all the facts and circumstances of every individual business. And I think it's going to come down to the documentation of what their needs were when they applied for this loan. Well, then they later came back and said, and by the way, when this came out, they also said that there would be significant penalties and possible prison time because they felt that people were answering this incorrectly and that they could bring fraud charges against people. So the penalties were as high as $1 million. So I think this scared a lot of people. So then the SBA came out and they basically said that if you returned the money by May 7th, that you were deemed to make a good faith certification. Because there was additional clarity around this, did I really need the money? And again, I want everybody to understand that we still don't know what that part means. Did I really need the money? Did I have sufficient liquidity? That is the piece that we're still waiting on the SBA to clarify, because nobody knows the answer to that right now. And so really what we're telling people is you have to look at your unique facts and circumstances and then document the reasons that you had when you applied for this loan. I think we know that there is economic uncertainty right now for everything that's happening. No one knows when we're going to go back to work. No one knows when people are going to be moving freely in public anymore. That's just an unknown. So I think the economic uncertainty is certainly there. But I think what we need to do is we need to go one step beyond that, and we need to document what that meant for your business. And some examples I'm going to give are if you planned on laying people off, because remember, the whole purpose behind the PPP was to keep employees employed. That was the whole reason. And I often apply a very logical thinking and say, well, what does that mean? Well, I think they wouldn't have done a lot of the things that they did if that wasn't their intent. So the intent to keep employees employed, we have to remember that. And so I think one of the documentations is, had you planned on laying people off if you didn't apply for this PPP? And so I think that's documentation. I think it doesn't go just to financial statements, and you really have to look beyond that. And you have to look at other facts that are occurring right now in your business that could later hurt your company. One situation, are you a business possibly that you're still an essential business, but you have employees working there. Maybe they're 6 feet apart, but maybe it's a fairly large operation. What happens if one of those employees gets sick and that spreads through your business and now your business is unable to function? So I think those are some of the things that you have to think about. If you are a contractor that maybe had a backlog and you're still busy right now because you have this backlog, but what happens if you don't have any new contracts coming up? Well, that's certainly going to affect you. And I think that certainly displays some economic concern. So those are the things that I think it's going to become really important for businesses to have these conversations with their financial advisors, their accountants, their attorneys. And I think it's going to come down to this good faith certification. And because we're still waiting on additional guidance, the SBA came back yesterday and said, we are now extending that deadline to May 14th. So originally it was a May 7th deadline, or I'm sorry, May 6th. And now they've extended it to May 7th. Now they've extended it to May 14th because we're waiting on this additional guidance from them. And we're hoping that this gives us a little bit more information that we can pass on to people. But unfortunately, right now, the advice we can give people is sit tight and start documenting that information. And I really hate to see people running scared and everybody giving the money back because they're afraid. It is possible that there will be companies out there that are giving the money back, and there's legitimate reasons why they're doing that. But I think there's also going to be a lot of companies out there that have every intention and really should keep this money. So I hope that somehow answers some of that question.
Thank you for that, Nancy. I know this is a topic with a lot of anxiety around it. So please stay tuned. And as we mentioned before, reach out to your advisors because everybody's unique. Before I go into my next question for the panel, I'm just going to mention now would be a good time to start sending in some questions via the chat function if you have it. I will be looking at those as they come in. and offering those up to the group. But I have a few more questions for you guys. I've heard the expenses paid using the PPP funds may not be deductible on tax returns. And I'm just wondering if maybe if Eric, if that's you, if you wouldn't mind clarifying that.
Yeah, I can clarify that. There's a short answer and then there's a really long answer. So we'll start with the short answer. The short answer is when this bill was originally drafted, the forgiveness amount that a company received would not be considered taxable income. And so there would be a resulting tax benefit from that, because if you think of it, you're getting a loan, it's going to be forgiven, and you're spending it on expenses that are otherwise deductible. So, you know, that was the intent of the law, and it's an additional tax benefit to add cash flow to businesses. So who doesn't like that? Well, the IRS didn't like that. And so the IRS now has issued a rule that said, well, if you get a tax exempt amount because of the forgiveness, then those expenses likewise are not deductible. Okay. And so what does that mean? That means that the fact that the income from the forgiveness is not taxable is really offset by the fact that the expenses related to that income are not deductible. And in effect, it's as if the tax exempt income of the loan forgiveness has no beneficial tax effect at all. And so really what's happened here is it's kind of like a tennis match, right? The serve goes over and Congress says this is going to be tax exempt income. And the IRS volleys back and says, well, okay, it's tax exempt income, but then the expenses, they're not deductible. Okay, and who's the tennis ball? Well, we're all the tennis ball in the middle here. And now Congress is looking to hit it back again because there's another bill that is being introduced, and we don't know if it's going to pass or not, that is going to clarify and say, yes, these expenses are indeed deductible. So where we sit right now is that the income is not taxable, the expenses are not deductible, but Congress has a bill pending that would again make those expenses deductible. We don't know if it's going to pass or not. If it's going to be a standalone, or it might end up getting part of another stimulus package.
All right, thank you. I know there are a few companies that are on that have not gotten a PPP loan, but are asking, you know, can they still apply if they haven't done so yet?
So the question to that is absolutely. I would encourage anyone who meets the criteria of getting a PPP to absolutely apply for a PPP. I know that there is this 8-week covered period that begins from the date the funds are deposited into your account. So again, the date the funds are deposited, that's when the 8 weeks starts. And I know that this goes until June 30th, and we're probably about at the 8-week time period right now with June 30th. We may even be over it. However, there has been some discussions in Washington about extending this 8-week period. So again, as it sits right now, it's through June 30th. But I think for those businesses that were forced to shut down and laid their employees off and didn't pay their employees to do nothing, they really wanted to use these funds to pay their employees when they could come back to work again. And I don't think that anyone anticipated the length that this would go on. And so we still have businesses that aren't open. And so I think the idea in a possible extension is to give an opportunity for those businesses to bring their employees back when they're open and still get those funds forgiven within that 8-week period. So I think we're going to see some more guidance on this coming out in the next weeks. But absolutely, I would certainly continue to apply. And in the event they don't change that rule and the 8-week period does end on June 30th, the reality is it still could possibly be forgiven for 6 or 7 weeks. So you wouldn't want to lose out on that opportunity.
Nancy, I would also add that, you know, we talk about extending it forward. We might also be able to take it and they might open up the period and say, you can receive it, you can go back 2 weeks or whatever and catch it, catch the full 8 weeks another way. So
Absolutely.
I think we gotta, you grab what you can in this particular case. And, worst comes to worst, you get 6 weeks or 5 weeks of forgiveness and not the full 8. That's still 5 weeks of support that you didn't have before.
Right. And actually, Dan, you bring up a good point. Thank you for the segue into the 8 weeks and what's covered, and the fact that they may go back and change the timeline and let people pick the 8 weeks that best suits their situation. That's a possibility. But I'm getting a lot of people asking about how the payroll falls into that 8 weeks. Is it accrued payroll? Is it date of the check? So the guidance has come out since the original act that now says paid and incurred. So that leaves us asking, is this cash basis? Is this accrual basis? What does paid and incurred mean? So I think, again, this is something we're waiting for more guidance on, but I do think in the spirit of the PPP that businesses are going to be able to get 8 weeks of payroll forgiven. And so the fact that if they get a loan on a Friday and they have a payroll that has a paycheck on Monday, I think that that could possibly be included in this 8-week period, because when you look at it on the back end, there's going to be an accrued 2-week period that might not get paid until after the 8 weeks. So I think when you map it out, I think the whole idea is to get 8 weeks of payroll for people. And I think that's the intent of this. My other point with incurred and paid is keep in mind that that means that you cannot prepay things like rent or utilities. I've also gotten a lot of questions on what is included in utilities. Utilities includes gas, electric, water, telephone, internet, and transportation, but please don't ask me what transportation means because I have no idea, nor does it appear anyone else does at this point. But that's what's included in utilities. The utilities have to be in place prior to February 15th in order to use those. So you can't go out there and maybe put everybody's cell phone in place on February 20th and think that that's going to be covered in the forgiveness, because that's not going to work. So it has to be utilities that were already in place prior to February 15th. But again, because it's paid and incurred, I think the idea here is if you have a phone bill and it covers a period of June, don't wait until July 15th to pay it by June 30th.
Okay, thank you for that, Nancy. And actually some of that that you just addressed as far as the payroll piece, I think probably addresses a few of the questions that have come in. Thank you to everyone who's sending in those questions. I'm reading them as they come in. Just to be aware, we do have several hundred people on this webinar today. So we're just going to do our best to kind of bunch some of these topics together. I think one of the things I'm seeing a lot of you guys is documentation. A lot of questions around, number one, is there standard documentation for what people should be putting together? What are our recommendations for how we should be documenting this? Are there spreadsheets, calculations? And then is it the SBA that it's going to be reviewing these, or is it the issuing bank? So sorry, that's kind of 3 questions.
Eric, you want to take that one?
I had to find my unmute button. So the documentation, I think, is similar to what had to be put together for the banks to check off on. The banks were looking for 941s and payroll records in order to approve the loan. We believe there's going to be some standard documentation that they're going to ask for in order to approve forgiveness. And it is likely they're going to have some kind of form. I describe it like a tax form that you're going to have to fill out. But none of that exists just yet. So the documentation is likely, though, to be how can you establish payroll records? Probably with a payroll register. How can you establish rent? Oh, here's the receipts for the rent I had. Same with utilities. So it's likely to be just the backup that you would supply an auditor, for example, if you were being audited by the IRS. Now, I don't know that the banks are going to review and tie out all that documentation, because the banks do have a certain amount of time that they have to approve these loan forgivenesses once they're turned in. And I believe that's just 60 days. So if you think of all the thousands of loans that are out there, for the banks to make these approvals within 60 days, you'd expect some spot checking there, but they certainly aren't going to be able to do a thorough review of all your calculations. I think that could come later with a further review by the SBA. The SBA has already said they're going to audit any loan over $2 million. So what does that mean? Are they going to audit it just for the numbers and the calculations? Are they going to audit it for the judgment call that was made that these loans were necessary? So we don't know what that audit process is going to look like either, but that might include then keeping your documentation on hand for just, here's the calculations we made and the documents behind that, such as the payroll, utilities, the rent bills. But then also, here's our documentation for why we figured this loan was necessary.
Eric, I agree with you. I think the audits will include the necessity of the SBA loan. So I think that's where that documentation, to start documenting that now, I think is going to be important to lay out your facts and circumstances for needing the loan.
Nancy, do you feel the SBA has the size of capacity people needed to audit these?
No.
Okay.
That is definitely a concern. Yeah, I think that's going to be interesting to see what happens there.
Right. And so what I think they're going to have to do is make it very regimented how they do this. What I'm hoping that the SBA does in this guidance is issue guidance that would also be used then in the future to test the necessity of it. And it's going to have to be less judgment and more mechanical testing. If it's not, I just don't see how the SBA can administer a judgment call test while they are auditing all the loans over 2 million. I just don't know they have the resources to do that.
I would agree with you. One of the things that I wanted to mention too is that I do anticipate for the forgiveness piece that each bank is going to be coming out with their own worksheet. So although we have worksheets that we have developed internally, and I know that I have provided some to my clients, I do think that each bank will have their own worksheet. You're probably going to want to give them the information in the matter that they would like to see it in. So I think it's perfectly acceptable to reach out to your bank now. They're probably going to tell you the same thing we are, that we don't have that information available. But I have seen some banks already provide worksheets. So I think it's okay to reach out to your banker and ask them if they can provide that worksheet for you.
Okay, guys, we've got a few different questions coming in that are all kind of similar and touching on which employee benefits are included in the PPP loan calculation. So we have some questions about HSA contributions, dental and vision, and then whether or not the employee portion of the healthcare costs should be included as well. So perhaps that's something we can address en masse. So
I think, first of all, the employee portion, boy, that's tough to say, cannot be included. The PPP clearly says employer paid group health insurance. That is the definition of it. Does that include dental? I would say dental is so minimal that I'm not sure that it would be significant or insignificant to add it. But it is definitely employer portion of the group health. I do not believe that that includes any type of life insurance. I think it's still to be determined if HSA is included in there. And was there something else, Lee, that you had mentioned in there?
It was, I think you addressed them all. It was dental and vision was maybe the other one.
And I would say, again, I think vision is pretty minimal, and I think that can be included under the group health.
Okay, great. Thank you. Hopefully that provides some clarity for those several questions that were coming in. Also, a couple questions that have come in about the ability to use, if you're not able to get 75% of the cost for payroll, any sense on how that forgiveness is going to work?
Eric, you want me to take this one or you want to take it?
Why don't you take this one, but I might have a comment on it.
Yeah. So the 75%, so actually we're hearing a little bit more information about this in recent days too. There's been some clarity. So the way the 75% works is that you are going to be forgiven for the payroll paid or the payroll costs in these 8 weeks. And 25% of those costs can be for rent, utilities, mortgage interest. So I think we have to be careful because I think people are thinking that whatever the total loan is, that they're going to get this automatic 75% forgiven. Well, you're going to have to do the worksheet to actually calculate the payroll costs that were paid. And then up to 25, you can take 25% of that and use that for the rent and utilities. So the 25%, first of all, is not 25% of the total loan proceeds that you can use for rent, utilities, and mortgage interest. The calculation is a little bit different from that. So I think we have to remember we're dealing with two totally separate time periods. We're dealing with a time period that was used to determine the loan proceeds, which was an average of an entire year, and it could have included bonuses and other things that aren't going to be paid in these 8 weeks. So we're dealing with that average, and then we're dealing with an 8 weeks of actual pay. And so if you had the same number of FTEs and everybody got the same wage, the same salary as they had in 2019, then I think you're going to be probably looking at 100% of loan forgiveness, assuming that you have 25% in rent, utilities, and mortgage interest. Now, if your FTEs have gone down and you have not brought that FTE number back up by June 30th, and I think that's important to remember that we have until June 30th to restore our FTEs. So what that means is if your 8-week covered period ends on June 15th and you are not up to full capacity, don't apply for loan forgiveness yet because you have until June 30th to restore those FTEs. If you did not restore those FTEs, then there will be a percentage applied, and the percentage of those, the number of FTEs that have gone down, that percentage will be a reduction in the loan forgiveness. So if you had 100%, but you reduced it by 25, you're going to get 75% of the actual costs paid. And then there's also a calculation to look at any one individual that their wages have gone below 25%. So you have this 25% cushion. So if you paid somebody $1,000, there's not going to be a reduction if you paid them $750 because you have a 25% cushion. However, if that reduction goes below 25%, then that could be a further reduction in the forgiveness calculation. So I think this is where people really need to be tracking where they're at, looking at what their loan was, mapping out their 8 weeks of payroll, and kind of tracking what they need. Because, you know, you can pay people. I've heard of people paying hazard pay and some other things in these 8 weeks for people who are coming to work. So I think it's important to keep that in mind, that you want to really track to see where you're at to get the maximum forgiveness, but also understand that we're not dealing with the same time period. So it is possible that someone's not going to see 100%. But you certainly want to work on that. I hope that answered. That was kind of a long answer, but hopefully I clarified some of that.
So Nancy, I would add to that, I'm actually seeing a lot of companies that aren't going to be able to use the whole loan forgiveness because, you know, the measurement to calculate the loan was 2.5 months, right? And this is an 8-week period. And in fact, even if the payroll is the same in 20 as it was in 19, they're still not going to catch it up with the rest of the costs being rent and utilities and interest. And so they're going to have amount left over. What happens with that amount left over? And I've heard two things now from different advisors. One is that amount left over turns into a loan, right? That's payable back within 2 years at 1% interest. Can that amount left over be used on anything that they want to use it on? Or can that amount left over still, is it required, even as a loan, to be used on specifically payroll, rent, utilities, even though it's not going to be forgiven anymore?
So that's a great question, Eric, and I've gotten that before. I did sit in on a webinar that was given by an attorney who works with the SBA. He said, although, again, this was interpretation, because everybody's interpreting things a little bit here, he felt that at that point that it converts to a loan and you're being charged a 1% interest rate and it has to be paid back, that you could now use that money for whatever you want. However, I will say that that's not what the PPP says. It says that you're certifying to use the funds for this specific payroll costs and these other, rent, utilities, mortgage interest. That's what the PPP says, if you actually read it. So I think there's still some clarification that we need, because my interpretation is it must be used for those expenses within the 8-week time period. And that once you go outside of that 8-week time period and it becomes an interest-bearing debt on your balance sheet, that you then can use it for other things. But again, my interpretation. So hopefully we'll get some more guidance on that.
I guess I would add that I don't know how worked up I would get about that, because unless you're going to not stop paying the employees and stop paying rent,
Right.
you're going to use the money. And I think you can attribute it to that loan activity as well. So, I mean, I understand the point and I understand the analysis to it. I just wonder whether we should get too worried about it at this point. But it's something we'll keep our eye on, and definitely, more clarification probably will come out on that.
Yeah, Dan, I couldn't agree with you more. I can't imagine how they're going to be able to trace funds beyond 8 weeks to see what that money was actually even used for. Because a lot of banks were not allowing companies to set up separate accounts for this money. They did not want them to do that. They wanted it put in their regular checking account. So I can't imagine they would be able to do any type of money tracing beyond that. And to your point, if they still have payroll, that's what it's going to end up getting used for.
Okay, thank you guys for that. I think just real quick, if you guys can touch on, because we've had several questions coming in on how to calculate loan forgiveness as it relates to part-time employees. Can you just address that real briefly?
So I'll take a crack at that. So I think what we're doing is we're looking at full-time equivalents. And so there are calculations for full-time equivalents. Now, I've also heard people say head count, that they're counting head count. But I have kind of stuck to the same formula that uses full-time equivalents. So there is a calculation which would then include part-time people.
Okay, thank you for that, Nancy. And just being aware of the time, I'm going to wrap up here. I want to let everybody on the webinar know we have created a resource page where the recording of this webinar will be located, as well as additional information and resources on COVID-19. Bookmark svaccountants.com/COVID-19 as a resource for you and your business. We do have a couple of scheduled webinars coming up. One is next Wednesday and is specific to dental practices. And we have one coming up on May 19th titled Using Data to Manage Through COVID-19 Uncertainty. We also have plans for additional webinars, but just like this one, we're planning to kind of schedule them as issues arise and things come up. So please stay tuned as we'll get information out there when we know what we're doing. I would also just like to thank Eric, Nancy, and Dan, and really all the SVA staff for working so tirelessly to provide information to all of our clients and, really the entire business community. Thank you guys. I know you put in a lot of extra time and effort here, and I think it's really appreciated. I'd also like to remind everyone on the webinar today that the SVA team is only a phone call or an email away. So if you're a client, feel free to reach out to your SVA professional as questions arise. If you're not currently an SVA client, contact me, Lee Schwartz. I can get you the help that you need. I know there are many other questions we didn't get to today. I'm sorry we got to as much as we could, but please reach out to us. We're happy to help in any way we can. Thank you again for joining us today. Hang in there and be well.
Thanks, Lee.
Thanks, Lee.